Ladies and gentlemen, my name is Jesse Regali, and you're listening to Working Capital. My guest today is Gord Wadley. Gord is the Chief Operating Officer for the Office REIT at Dream Unlimited in Toronto. Gord, how you doing today?
I'm doing great. Thanks for having me, Jesse. I'm looking forward to being a part of this.
Yeah, it's great to have you on. For those that don't know your background, Gord, maybe what we could do is talk a little bit about how you got into kind of the real estate space, and then subsequently working with Dream and in your current role.
Yeah, no problem. So I've been in the industry for close to about 20 years. Right out of university, I worked for a large national brokerage and was doing tenant rep work, a lot of corporate services work for large mandates, and did that for about 5 years. Then I joined Dream Unlimited about 13 years ago and have been working there ever since. I've been in a number of different roles, worked in a number of different capacities, but I initially started my role as the Director of Leasing and Property Management for Ottawa. And then my role expanded as we grew to Quebec and Atlantic Canada. And then it was 2016. I got a call from Michael Cooper, my boss, and Jane, um, asking about an opportunity here in Toronto. My wife being from Toronto, it seemed like a really great opportunity, and I've always really loved the company and being a part of the Dream culture. So it was a no brainer for me to move, and started my role in 2016 as the Vice President of Leasing for Dream's downtown portfolio. Over that time, I grew into a Senior Vice President role of asset management. And for the last 4 years, I've been the Chief Operating Officer for the Office REIT. So basically, what that entails is I help manage all facets of the income and expense portion of our business. So leasing, construction, development, technical services, asset management, and property operations. And that's on just over 5 million square feet of office space. And it's predominantly all downtown Toronto. And there's a few buildings in Western Canada still that we own and manage. In addition to this, our team's responsible for the leasing and operations of about another 1,600 residential units and about another million square feet of stabilized income and retail properties in Dream Unlimited. So beautiful sites like the Distillery District, Zibi in Ottawa, and Canary and West Don Lands. So it's a lot of great stuff. Our team's got a great opportunity to do some really impactful projects.
That's really cool. And when you started your career, if correct me if I'm wrong, you were on the brokerage end at CBRE.
Yeah, it was CBRE. I was on the brokerage end there for about 5 years. Started as a research analyst, got to know the business, and then moved into office leasing. And when you're in a tertiary market like Ottawa, you tend to gravitate to a lot of different disciplines. So did some small scale investment work as well too. And it was a great place to learn the business and cut your teeth, and working for a really good company and with some great people.
Yeah, absolutely. And in terms of, you mentioned Mike Cooper, so the founder of Dream REIT, and you've been there long enough to kind of see the company grow. What has been that experience like from where you started at the company and what it's grown to today?
Yeah, it's been a tremendous experience, and there's been a lot of different avenues. We were a pure play office REIT for the longest time, and we've been really moving into development opportunities. The business has grown. Dream Industrial is one of the largest industrial REITs in the country as well too. Dream Unlimited has a number of tremendous residential opportunities, and some mixed-use development opportunities as well too. So there's no shortage of really good and evolving projects to work on. The thing I love the most about Dream is it is really a team atmosphere. Like I said, I've been here almost 14 years, and it's a great culture with great people that really don't have any egos and just want to be a part of something special. And that really starts with the management team. Our company's very lateral. Anytime you want an opportunity to speak with Michael or any of the senior management or Jane Gavin, everybody's always available there to support. And we have so many kind of younger high achievers that have made their way through Dream, gone on to great careers, have stayed at Dream. And I think the biggest testament of our company is just everybody gets an opportunity to really make a difference and get involved in some great projects.
Yeah, well, I've had the pleasure of working with a number of people at Dream. Shout out to Kyle, Melody, and Kingsley. We've worked on the office and retail side. I'm curious, for those that don't know, a lot of companies in the commercial real estate world, you'll see different segments, whether it's Brookfield, Allied, Dream, where you have the industrial side, the office side. Do you guys just kind of split up with the different companies based on asset class? And has that always been the case at Dream, or do you do that differently there?
No, we predominantly break up the companies based on asset class. Like we really want to be market experts in the work that we do. Our CEO of the industrial REIT is Alex Sanikoff. He's got a very big team of people that manage some best in class industrial, all over Canada, and Europe and the United States. We have a really big and evolving pipeline of multifamily. We have a specific team that works on that. And then our income properties, so commercial and retail, it's predominantly the same team across Dream Unlimited and the Dream Office REIT. And that really allows us to use best practices across the companies and make sure we're getting the best results for all our stakeholders.
So on that topic of asset classes, we've kind of seen over the last few years a lot has changed. We've had shocks, not just economic, but just in general in North America and worldwide. When it comes to the different asset classes, maybe we could touch on all of them briefly. Obviously, we can't go too deep on each one, but
Sure.
maybe we can start with industrial. Industrial seems to be the hot topic in our world for the last couple of years. Have you seen any changes to that? Do you think that trend will continue? We've seen that low vacancy continue in 2023, now in 2024. What are your thoughts there, and how do you and the team view the industrial side?
Well, I think the fundamentals in industrial are very strong, and I think they're going to continue to be strong. I don't specifically work in the industrial REIT, but of a lot of investors and lenders and people that we speak to for Dream Office, often tell us that they have a great appetite in opportunities in evolved markets like Toronto, major markets throughout North America for industrial. And as we grow our workforce and businesses continue to grow, I think industrials continue to remain strong. The fundamentals are strong. Rents are good. Cap rates have remained low, and there seems to be a real appetite for investment in industrial. So I don't foresee that changing anytime soon. Another asset class that I spend some time with is residential, and I think it's been really well publicized that the residential rental market has been really strong. In our portfolio, we're seeing really good rent and growth on turnover. Cap rates are low, they're stable, and also there's been really strong demand for rentals in Canada, and that's in every market. We have rentals in Saskatchewan, Ottawa-Gatineau. We have a number of units here in Toronto, and rents in the GTA, they're strong. They're about $4 a foot, and occupancy is really high with really short turnovers. And another sector I've taken some solace in and feel really good about is retail. It's been a great sector for us, and been a great complementary amenity to our business. We've gotten some great deals done in the downtown core in Toronto at really good rents. They provide a tremendous amount of cachet to our assets and a number of amenities, not just to our tenants, but to all the tenants in the core. I mentioned to you offline that we recently did an incredible deal with Costas Spilidas and the team at Milos to bring Milos's first restaurant here to Toronto. We've partnered with Charles Caboth and Inc. Entertainment to bring a beautiful concept on Richmond Street, Daphne, which if anyone listening hasn't had an opportunity to go to, I'd invite you to go to it. And we continue to evolve and do some great deals in the core on the retail side. All the good stuff being said, I'll probably beat you to your next question, but the obvious challenge for everybody right now has been the office sector. And those challenges have been well publicized the better part of about the last 3.5 years. I get asked all the time, how would I define the office sector? And to be candid with you, the best way I can describe it is dislocated, Jesse. If you think about it, over the last 3 years, you'll see one hot take or something, or you'll see something where one performance metric seems to improve, and you see some sort of hope or indication of stability. The overall vacancy rates, there's improvements in absorption. But when you see that traditionally over the last 36 months, you've also seen an increase in sublet supply or some sort of other cost consideration that would have an impact in NERs and values. So while you kind of see one good thing, you kind of see one bad thing. So there's a real dislocation in the office market right now. And I think people are really starting to see that, and investors are definitely seeing that. That all being said, there is still some optimism out there, and we're starting to hit a bit of an inflection point on how we're performing as a company and seeing some positive things. But the days and the sentiment around office, traditionally has been compressed NERs, growing vacancy, tempered NOI expectations, higher cap rates, and that's had a real impact to value over the last few years. And
Yeah.
Go ahead.
No, I agree. I think it's kind of dislocated it's such a good way to describe it, because I think we're all feeling that in this sector on the office properties. I mean, I don't envy anybody getting into the industry on the office capital market side, especially with the long deal cycle. That's office. In addition to that, having to deal with debt markets and interest rates. On that topic, though, I don't know if you have looked at the research that you do at Dream, but we've been putting out, because one thing that was happening in the last few months, we've been seeing that these AAA assets and trophy assets were very hard to find in Toronto when we had vacancy or availability at 14, 15, 20%, even depending on which asset class you look at or subgroup within the asset class. But what we notice, and you can go to Avis and Young, our website, to see any of these reports. But I'm looking at it now, and direct vacancy by class with the trophy assets all the way down at 3.2%, Class A at 10%, which is
incredible.
A huge difference than the general office availability, which I think we have pegged at around 20%. Have you noticed that same thing when it comes to the actual asset type itself within the office larger category?
That's a great point, Jesse, and very much so. We actually use AY's research material on a lot of our quarterly board and update materials as well too. So it's a great resource for us. The Class A market has been nationally very strong. They often boast many of the amenities and services and operations that tenants covet. Like, one thing that's driving the performance of the overall market is that tenants and brokers coming out of the pandemic, they're dramatically more sophisticated in terms of office accommodations and expectations. They're much more aware of base building systems, HVAC, mechanical, overall design features and amenities. These all have real impacts on their operations. That being said, these are predominantly best in class in A-class buildings. So there's a real opportunity for them to do a lot of deals there, and the A-class has weathered quite well. It's the B and the C-class assets that have the glut of functionally obsolescent buildings. And to me, that's what's really weighing down the story around office and really weighing down the narrative around vacancy. Because like I said, many tenants are much more sophisticated on where they want to be. And you have a real have and have not situation nationally. And Class A, well-located assets have weathered the storm very, very well.
And do you think that is a function of the amenitized space itself, or a combination of amenitized and transit? Because what we've seen is, for those that don't know the Toronto area, I think this goes for major markets in the States and Canada more broadly, but we had trendy areas like the West End in Toronto, where 5 years ago it was the hot place to be if you're, say, a technology company, startup company, that they would never go to the financial core. They just didn't want that old traditional style of space, or what they thought that space would be. And now we're finding that the top of the list is financial core, transit connected, downtown, regardless of the type of company. So I guess to the question, do you think that is the choice for those type of assets is a combination of employees coming in from different areas, the amenities in the space? How do you see that?
Yeah, it's a combination of all of the above. It's expensive to live in downtown Toronto. If you're bringing people in from suburban areas, it's probably beneficial to the landlord if you're on or near transit. So that's always been a driver. And like I said before, like it's incredible how much more sophisticated tenant reps are and tenants themselves around the type of space that they want. So buildings that have the best HVAC, destination dispatch on their elevators, a really good service offering, people will pay a little bit more for that and they really covet it. And that's why I think you're going to see these traditional, C-class buildings that are kind of functionally obsolescent really become victims of the vacancy market right now, because there is some deals there out in the market. Uh, there is a glut of sublet space in Toronto, and a lot of those are good spaces where there's an opportunity for people to go in and get some good plug and play space that really suit their business.
Yeah, I think it's well, like you said, I think it was dislocated. It's going to be something that 2024 and 2025. I still think there's a big question mark as to where this bottoms out in terms of how much space companies end up taking. Because to the average person that's outside of our industry, you see that office vacancy is high. You see some companies that are doing 3-4 days a week, maybe 2 days a week, whatever that is. In the beginning, 2 years ago, 3 years ago, everybody was like, we need a lot more space because we can't be close to people. I don't know if that has really changed over the last little while. So to finally see where we end up in terms of if you're a 5,000 square foot company, if you need 5,000 square feet, or if you need a smaller space, or you just need more flexibility. Because I'm sure you've seen this as well. One of the things that is not seen from the actual rental figures is the flexibility of landlords, putting free rent into the deal, having options for the tenants of being able to either terminate early or being able to have different optionality with their growth. I think that's becoming more of something that tenants are expecting, because they're now, for the first time in a long time, in the driver's seat.
Jesse, that's a heck of a great point, and we're seeing that right across the board. So predominantly, Corinne Durazio, she's our vice president of leasing, and when we look at a lot of the leases that Corinne and her team are doing, um, before 2019, it was a 5-year deal, it was a 10-year deal. If you wanted to put more capital into the deal, you'd amortize a little bit longer. Even on 5-year deals, we're starting to see a lot of tenants and brokers really push flexibility options. So ROFOs on space, rights of first opportunity, rights of first refusal, and termination options. I've never been in an environment like this in 20 years where there's termination options. Granted, usually it's for the unamortized costs that the landlord are putting in the deal, to be fair, but the ability for brokers to push these type of options has never been more prevalent in the last little while. So that's been a real material thing, but it's got a bit of a compounding effect from a valuation perspective. Buildings are valued on the in-place income that they have, the type of covenant they have, and then the weighted average lease term plays a predominant role in the value of the building too. So, it's kind of a really interesting juxtaposition when you're negotiating deals, and you're on both sides of the table, so you know what it's like. It's a bit of an interesting position to be in. But in a tenant's market, or in a market where there is where there is a bit of an influx of vacancy, I think there has to be give and take on both sides, and we've seen a number of deals that have options to terminate.
Yeah, no, just having that flexibility and providing solutions. And speaking of solutions, I wanted to let listeners know that we have a product code that we're going to be putting in the description for Magic Mine. This is a product, if you're not aware of, that I've used for a few months now. I've been drinking 3 coffees a day. Gord, I'm not sure if you can relate to this, but I've been trying to cut back on that. And as a result, I saw these ads online, used the product, so was able to kind of cut back. There's a bunch of different benefits that you get with the product. For those that are looking at the code, you can basically, by the end of January, you can use this code. We'll put it in the description. Get 1 month free when you're subscribing for 3 months, or get 20% off. And just type in estate 20 and the link that I provide. So, Gord, I would be remiss if I did not talk about a little bit about the news that came out in November. I heard you on a couple calls get asked about the WeWork situation in terms of the bankruptcy that they filed in Canada. I was just curious, more generally on co-working. I have obviously I have a certain opinion, and I think brokerage has a certain opinion on what co-working is and the place it has in our business. And it does, I think, solve a particular challenge that some companies have, and I really do think it is a solution for a lot of companies. What are your thoughts on co-working in 2024, and how do you see co-working? How do you see this evolving over the next little while?
Yeah, that's a good question. I'll start with WeWork. WeWork's been a good client of ours and a good tenant of ours for just over 4 years now, or close to it. They've been in one of our landmark buildings at 357 Bay. It's at the corner of Bay and Temperance, and it's just a beautiful, fully restored heritage building. They've been a great tenant. They've been good to deal with, always straightforward and honest with us, and they have a really good offering there. And a lot of people go there. They have a lot of clients of their own. I think the building's got a great occupancy, and it's a best-in-class luxury boutique building. So we feel really good about our relationship with them, and they've always been someone we like to do business with. And there's a lot of good co-working operators out there. We do a lot with Regis and Spaces. The team there is very sophisticated to deal with. Workhouse is a client of ours. EQ or IQ Office is a client of ours as well too. They're all great groups, and I think before the pandemic, you saw a lot of co-working groups absorbing space at a really rapid clip. And over the course of the last kind of 3 or 4 years, you've seen a lot of these groups right size, and I think it's just a natural evolution. I think most of the right sizing has happened. I know all our co-working clients have done and have fared much better over the last 18 months in terms of their own occupancy and their own goals. They all create good spaces that are flexible. And if you're a startup company, leasing office space in a high inflationary, high interest rate environment, everybody's looking at their own balance sheet and capital preservation. Having the flexibility to kind of grow and retract in co-working is a really good option. And, if you're a big, large enterprise client and you're looking to drop down in different locations and you're constantly growing and right sizing there as well too, like co-working is a great flexible opportunity. I think there's, the 4 that we deal with are all really good operators, and they add value to the space. Each one of them has a really unique and bespoke feel to it, and they do a great job. We have a partnership agreement with Industrious at our headquarters at 30 Adelaide. They've been tremendous to deal with, and some of the benefits is you get some really good, fully improved space. And if you've got a good relationship, there's always opportunities to work with your co-working partners and grow some of those tenants that are in co-working organically in your owned assets, fully owned assets, and things like that. So, I'm fairly confident co-working's here to stay. I think it provides a real service to a niche component of the market, and at Dream, we've been real fortunate to have some good co-working partners.
Yeah, and I was talking to one of the guys in our office, and we were kind of talking about, as landlords like Dream, like other landlords, become more flexible with terms. What does that mean for co-working? Because that was one of the big selling points was the flexibility. And I think ultimately it's not just that flexibility. Like from your perspective, you still want to do ideally 5-10 year deals, but you'll do 3-year deals. You can maybe do shorter than that. But we recently had IQ in our office, and they were talking about this thing that I don't know if they created the concept called bursts. And there's some companies that they'll have a couple weeks a year where they want that you can't take a vacation during this particular block of the year. Everybody comes in, and you can't do something like that in a traditional office where you can go into co-working, have that, have that touchdown for a month or a week or whatever it is, and be able to be in the space for a short period of time. And the other component is, you can't really test out landlords like you can co-working space. They'll allow you to do 6 months, 3 months, as you know. So I do think that, maybe it was just there was a little bit too much of that in a lot of these major markets in Canada and the U.S. But I definitely think it's solving a problem and a challenge for some companies. I think it'll always be a component of the market.
Yeah, I agree with you wholeheartedly. And the other nice thing too is, if you're growing your business and you're doing your business overseas and, you're based out of Toronto, like if you're in a Spaces or a WeWork, it's plug and play no matter where you go. Your membership can, you fly into, Berlin, you can go to the office there and spend the afternoon and get work done very seamlessly, very effectively, and it's market to market. So I think that's a really good feature, and I think that's why a lot of enterprise clients that aren't sure about where they want to be or how big they want their footprint to be, I think that's why they really covet and support co-working.
So I'd like to get the landlord's perspective on something that I think when I started, and even before, 10, 15 years ago, co-working, landlords wouldn't, they would say they're odd build outs. We don't want to, retake the space. Whereas now you see some of the build outs that they're doing are absolutely gorgeous. What's the view of, let's use the pool of operators that you mentioned here. It sounds like you're happy to take back that space, but in reality, is that taking back that space and modifying it, or do you end up bringing it back to base building and kind of maybe warm shelling it?
For just speaking specifically for the co-working spaces we have, they all look incredible. I don't know if you've had a chance, but if you go see WeWork space at 357, I'd argue it's some of the nicest office space in the city. And space like that, I think it's plug and play for anyone. And the larger co-working spaces, what they do is they do a really good job segmenting the build out. Like they'll have some space that has a lot of open concept, high density drop down desks, and then they'll have another floor that's some enclosed perimeter offices. So there's some really good functionality around there. So for the most part, like if we ever got any of our co-working space back, I think there's real value in the improvements that they have there. But as an asset manager and a building owner, you have to be prudent, not just with co-working, but any tenant that you're doing a deal with. Like you have to test the covenant. You have to make sure there's the proper security in place to protect the downside if the space comes back. So as good as the space fit up is and how conducive it is to another tenant coming in, sure, there might be some monetary savings on the next tenant, but you do want to protect yourself at the beginning on the downside. And I think with co-working, that's sometimes often the challenge is they want to get ramped up, get the income. And I think prudent landlords anyway, should just always make sure they've got the right security and covenant behind any of those deals.
Yeah, I completely agree. Want to kind of switch gears here and talk a little bit about the just the current economic environment, and you can't talk about that without talking about interest rates. From the perspective, publicly traded companies, where there's certain things we can control and certain things we can't. The economic environment we play in is not in our control. I'm curious what the view is of where we're at right now. As an economy with interest rates, is it glass half full, glass half empty? 2023, just say has been kind of was a crazy year. Hopefully we have a little bit more, let's call it just a little bit more of a steady year.
Yeah. You know what? I'll be honest with you, Jesse, I'm always a glass half full guy. But being a bit of a realist too, I would say it's almost been a perfect storm of challenges in the last 24 months. I think, don't quote me on this, but I'm pretty confident we've had at least 10 interest rate hikes since the end of 2021. And that puts a lot of pressure on landlords in a number of different ways. Like everyone else, I'm always cautiously optimistic that we're going to see some cuts towards the end of this year. And that should spur some optimism around the sector. But people have to keep in mind that tenants and businesses in any high interest and high inflationary environment, they're all trying to be prudent with their own balance sheet, and they're all trying to preserve capital, like every operating business. And in this environment, tenants often want to push costs to the landlord to protect their downside, protect their balance sheet, and manage risk. And what I've seen in the market is landlords that have been able to do deals and are the ones that have been able to spend, build turnkey suites, provide larger TIs that tenants often covet. And, it isn't often sustainable for the average landlord if the cost of capital is higher. You're borrowing more, you're impacting your own liquidity and potentially the ability to spend on the next deal. So you have to be, as an asset manager and as a manager, you have to be really disciplined in the deals that you do and where you do them. And another key component, everybody talks about the tenant side, but on the landlord side, another key component is refinancing assets. And it's never been more important. So getting good tenants, good covenants, and investing in assets where you need to show stable and strong cash flows have a real material impact to the value and the loan size of these buildings. So, for the most part, I've been real happy with what our team's been able to do. They've done a really good job. We've got some tremendous banking and lending partners right across the board that really see value in our assets. But we're lucky. We've got some of the best located assets in the country, and they've all performed. But not all the landlords are going to be in that opportunity or have that opportunity. And it's going to be really interesting to see over the next few months what the outcomes is for some of these C-class and vacant assets that do come up for renewal. We're not seeing a lot of asset trades in the market, but if there isn't any alleviation of the pressure around interest rates, I think we're going to start to see a couple of off-market deals where some landlords will have no choice but to sell.
And do you think 2024 is still going to be a bit of a price discovery, or call it price confusion market right now? Because we've seen quite a bit of assets that had gone to sale, maybe a couple of years ago, then taken off the market if owners not liking the pricing that they're getting. But now if you have an asset that you read these market reports that mark to market, it's come down. You don't want to sell these assets in this market. So I feel like 2023 has just been a story of kind of a bit of a frozen capital market.
1,000%, and especially on the office side, it's been a really frozen environment, and there hasn't been a ton of trades. But let's see what happens when interest rates come down a little bit. A lot of the good buildings have been doing a lot of leasing. There's been some really creative. The government stepped up and done a number of great programs to help landlords as well to add value to the buildings. Like the Canadian Infrastructure Bank has this decarbonization loan. We took advantage of it. We have about $136 million facility with it, where we're able to upgrade all our base building systems. So we're able to fully improve a building at a really cheap cost of capital. So 2% or sub 2% based on how much you decarbonize the building. But to do that, you have to put in, new HVAC, new mechanical, and all the things that you need to have a really good building that'll attract good tenants and be much more saleable, so to say. So, I think we need to see some more programs like that. But to your earlier point, I think at least for the near term of this year, the next kind of 6 to 8 months, we're not going to see too many asset sales.
So my hockey coach has always said, control the controllables.
Yeah, that's good advice.
Speaking of construction, we've done a white paper on this, and I think I've talked about it on the show before. And actually, I think, Gord, I'm not sure if it was you. I was listening to one of the investor calls that Dream was doing, and it was talking about, you have a location, the Good Life 137 Yonge Street in Toronto, and we were talking about adding residential, and just to the white paper, we could put another link in the show notes of conversion or addition, adding residential to office buildings. Now, we've talked a lot about, it's not just, the average person. If you think, you can just convert an office building just like that, it's a lot more challenging, and it has to be a very specific type of building. But I'm curious if you have explored residential components of your office, or if you've looked at conversion of office space.
Yeah, we've looked at it at a number of different sites and location, and it actually gives me a ton of optimism for the future about our company. And what I'd say is what I'm really excited about, and what not a lot of people know unless you listen to our investor calls, is that in the office REIT, we own assets in the GTA that have been approved with over 3 million square feet of residential density. And our team's worked really hard over the last couple of years to get the zoning and approvals necessary to secure the density. So in 2020, we achieved 500,000 square feet at 250 Dundas. We recently did more than 2 million square feet at 2200 Eglinton. And most recently, we did about 1.1 million square feet at the corner of King and Simcoe at 212, 220 King. It's a beautiful site with our partner Humboldt. We recently announced a JV partnership with Center Court to build 2 residential towers in phase 1 of 2200 Eglinton. That's about 630,000 square feet or 1,000 units. We can use some of these great opportunities on these conversions and development opportunities that we have in the REIT to develop. It's going to help us find more partners. It's going to help us unlock some significant liquidity, and that's going to help us with NAV growth. And I think that's great for our business, and it gives our team a really robust pipeline of great projects that they're all proud to work on and are really rewarding. You touched on it a little bit on the office conversions. It's been really difficult to date for anybody, and I would challenge anybody if they've been able to find a pro forma that's that accretive in this environment. And it's for a couple of reasons. Like, the cost of capital is high. We've talked about that quite a bit, but using Toronto for example, it's very prescriptive on rules and regulations around what you can do. So if you have an office building and you're redeveloping it, one mitigating factor is office replacement. If you're putting residential on 120,000 square foot office building, you have to replace it with 120,000 square feet of office. And unfortunately, sometimes that could be a real challenge to your pro forma, because the office space or the commercial space is valued much less than the residential space, and often it's not easy to absorb. So that's a tough one. The city is also very prescriptive on light penetration, setbacks. So things that really make it difficult to do conversions. But I do take a ton of solace in the fact that the government out there, like, they're asking the right questions, and they're looking to, we engage with the city, we engage with the province and the federal government, and they've all been asking the right questions. And I actually take a ton of solace in the fact that they're really trying to do their best to unlock some more residential development or conversions. So they're looking to implement policies to spur it at all levels. And the HST rebate from the feds announced a couple of quarters ago for housing, that was really well received. But municipalities like Calgary, we have a conversion site there at the Barclay Building 606, where the municipality is offering a $75 a foot abatement for the conversion. So that goes right to the bottom line of our pro forma, and it's really valuable to help us get these projects kicked off. So governments, we're starting to see them ask more questions. I've never seen them engage developers or the private and public sector like they have as of late. So that's been really positive for us, and I think it's really going to help us, towards our goal of unlocking more residential opportunities for all the new Canadians and Canadians that we currently have here.
Yeah, I couldn't agree more with you. We're both in real estate, so especially, or my view on this, it's going to be biased to real estate, but it's really encouraging to see market-oriented solutions as opposed to just prescriptive solutions, because it's infuriating to me that we have a lot of real estate in the country. We do have a lot of housing that can be made affordable, but it's just the question of being able to unlock that. So I couldn't agree more with that sentiment.
Yeah, the one facet, and I know they're thinking about it right now, but the most difficult one is just the office replacement on existing development sites.
Yeah.
When you're in a market that has growing vacancy right across the country, and we talked a little bit about these functionally obsolescent B and C class buildings. Are you going to invest a ton of your good capital into retrofitting these buildings to become office, or are you going to help the community and build some homes for Canadians and help the affordability cycle for that as well too? So I think we're starting to see we're really starting to see government look and potentially do the right thing, and I honestly feel really good about our prospects going forward.
Very cool. Well, I've got 2 final questions, and we'll wrap up here, Gord. So the first one is, how do you feel about 2024 in general, and what's coming on the horizon that we maybe have not heard that Dream will be doing or is doing? What's basically the 2024 outlook?
Yeah, the 2024 outlook, I'm cautiously optimistic. I know we talked a little bit about some of the challenges around office space, and everybody seems to measure, all the reports that we look at all seem to measure kind of traditional indicators. But as an asset manager, I try to look at non-traditional indicators. Parking income for us is over 100% of what it was in 2019. Gate and security swipes are at pre-COVID levels in our largest assets all across the board. And then last Labor Day, we've never printed more security passes than we did in a 30-day period. And you and I take the path pretty regularly. 4 days a week, there's incredible and growing traffic there. So I feel pretty good about our prospects. Specific to my business, we've had 5 straight quarters of growth in current and committed occupancy. So we've had more commitments than we've lost for 5 straight quarters, which is great. We talked about NERs a little bit earlier about the pressures. Everything costs more. Construction costs more. Unit material prices cost more. Rents aren't growing, so there's been a real impact to NERs. But the last 2 quarters, we've seen some improvement. It's very marginal, and it's a little bit slow, but we're actually seeing improvements to the NERs. And I'm finding that construction and trade prices have stabilized. We're starting to see some unit prices for materials actually come down, which is great. And there's almost been a pause right now on a lot of development. And we're starting to see trades and contractors calling, looking for opportunities. So I think we're going to get some in 2024. I think we're really going to see some benefits of better construction and material prices going forward, and we're already starting to see that now. And the absorption keeps moving forward. The provincial government, they're out in the market for almost 1 million square feet. They've been great users of space. There's a lot of industries that are growing, language schools, the educational sector, a lot of professional services firms. So we're actually starting to see some real growth, and I'm feeling good about that. Coupled with the very expected interest rate decrease, towards the middle or at the end of the year, I think that's going to really provide some sentiment to investors and to businesses as a whole, that we've kind of hit the inflection point and are going forward. And then, like I talked about before, the office REIT, we've got some unbelievable residential development opportunities and partner opportunities that we're all really excited to work on. So more information to come on that in the new year. So it's a lot for our team to look forward to, and it hasn't been the easiest few years, but I think the most part, Toronto landlords have done a really good job weathering the storm, and I think we're going to start to bear some real fruit coming out through the second half of this year.
Yeah, sounds good to me. I am also an internal optimist. I don't think you can be in the brokerage industry and not be, but I think
exactly.
There's definitely something that I think can be said for the fact that I think this can be a healthy start to the kind of next cycle in our industry. When I first started, even going through the great financial crisis today, prior to 2-3 years ago, where we had record growth for such a long time, and you almost got this feeling like something has to give here, because we can't just have a hockey stick for the rest of my working career. So I feel like we've gone through a lot of the challenges over the last couple years, and we could prudently move forward, and we'll see how it goes. But I think cautiously optimistic is probably the best disposition to have right now.
Yeah, you know what? I'm really confident in your team at AY. It's a good group there, and they're working hard. All the hard work that the brokers have been putting in, really getting sophisticated in their craft, making the cold calls, trying to find opportunities. That's all going to really pay off once this all turns around, and it's starting to. So I've got some real confidence in all the good brokerage shops that we have here in Toronto that they're going to continue to perform well.
Perfect. And I appreciate the comment. Last question, Gord, just in general, for the younger individuals that are coming into real estate, whether it's on the development side, the brokerage side, landlord side, what would be your advice to them, given the challenges we've talked about and the type of market that they're coming into? What would you say to those people?
Yeah, this is a good question, and I appreciate you asking it. I'd start by saying, all things being equal, like the formulas, the actual math in our business, it's relatively easy, and it hasn't changed for decades. We still run DCFs, and we look at return and value metrics the same way. once you know those formulas and how to read a pro forma, they stay consistent. And there's always great tools to help you improve in that arena. So having a good financial acumen, while it's important, I don't know if it's among the most important. I'd say what's of real importance, and what I'd recommend to new people getting in the industry, is really focus and work on your social skills, your EQ. It's not always comfortable to pick up the phone and cold call. It's not always comfortable to get out and network, but find a mentor, find a good friend or a peer that can help, introduce you to new people and new opportunities, and learn some new skills together. In the asset management, leasing, investment, and especially in brokerage, the most successful people and leaders I've seen over the last 20 years are the ones that have a good financial acumen, but a really high EQ and a good moral compass on how to treat and support people. I think your ability to explain, and you do a good job of this, Jesse, and your team, but your ability to explain in simple and real terms the outcomes you're trying to achieve is, of course, paramount, especially if you're in brokerage. But how you treat people really makes you someone that people want to be around, and it's a good cornerstone of good leadership. And obviously, it's important to work hard and be available, but that's all low-hanging fruit. I'm talking about having skills to be a good listener, be patient, practice empathy, work on your ego, and just be a good team player, and not be afraid to execute on your convictions. And those skills go a long way in adding value. If you're a part of a team and executing on collective goals, and just being a good teammate. I can speak, I've got a large team, and I'm grateful for all of them, but I can tell you, it's these well-rounded individuals, in my experience, that have the greatest success. And that's who I want to surround myself around. And they're usually the best contributors. So hopefully that answers your question.
Yeah, for sure. Those are great points. I mean, if I could rewind the clock, I would tell my younger self, don't overcomplicate things. And it's such a temptation when you're getting into any industry. You want to show, the people that hired you, how smart you are and how much you get it. And, now most of my job is the opposite. It's like you said, making things as simple as possible and being straightforward, and so that you're making sure that your messaging and your communication is crystal clear. It's a great 100%. Point. Awesome. 100%. So, Gord, for those that want to reach out, if they have any questions, they want to look into Dream, where can we send them? We can put links in the description or show notes.
Yeah. So dream.ca, that's our website. Anyone, please put my email in the notes as well too. I'm happy to meet and speak to any of your subscribers or anyone that took the time to listen. And those are probably the best way to see all the great stuff that we're doing. And I'm always available to talk to you, talk to anyone about what we're doing at Dream, and share all the good opportunities.
My guest today has been Gord Wadley. Gord, thanks for being part of Working Capital.
Well, thanks for having us, Jesse, and thanks to you and the team for all the great work you do for the industry as well too. I know you've helped us on a couple key files, but really appreciate all the efforts you guys are doing over at AY.